Hello everyone, welcome and thank you for joining us for our webinar today. My name is Lucy and I'm the Marketing Executive here at Vaultinum. For those of you who aren't all too familiar with Vaultinum, we are a European trusted third party established in 1976 and we specialise in the protection and audit of digital assets. We offer a full range of online solutions to help clients save time and improve efficiency in the way that they manage and value their digital assets. We do this mainly through deposit, to prove the ownership of your digital creations, software escrow, to secure business continuity in case of failure of your software provider, and Know Your Software. Know Your Software is a unique online tech due diligence solution that audits IP, maintainability, and cybersecurity risks and helps tech investors gain crucial knowledge of the technology, mitigate risk, and increase the value of their software asset. Today, I will be joined by Kristen Avon, our Senior Legal Officer here at Vaultinum, who has previous experience working in multiple high-tech industries, and we will be discussing what the key M&A tech trends of 2022 mean for investors as they look to the year ahead. The world has faced major challenges from the ongoing COVID-19 pandemic, and yet the disruptions have also created many opportunities. Nowhere is this more true than in the technology industry, which has been by far the most active area for investment by corporate and private equity firms, with companies in technology, media, and telecom sector propelling the M&A deal pipeline. Indeed, increased investment in technology created answers to many of the problems brought on by the pandemic. Despite this strong activity, tech M&A is faced with new and emerging challenges, such as increased regulatory scrutiny, the widespread use of open source software, and the persistent cybersecurity threats that are forcing practitioners and investors to rethink their strategies. On the other end of the spectrum, the automation of due diligence is revolutionizing the deal-making industry in order to meet these risks. The purpose of our webinar today is to explain how digitalization, increased competition, and the superabundance of capital have paved the way for the rise in tech M&A deals, and how these facts have led to an increased number of challenges for investors in the fields of cybercrime, compliance, and open source licensing. We'll also discuss how the due diligence offer needs to evolve to be able to meet these challenges and give solutions to investors to help them thoroughly identify the tech vulnerabilities and make informed decisions. We will then address any questions that may arise during the final 15 minutes of this session, which you can type into the question tab at the bottom right-hand side of your screen. I would also like to draw your attention to the chat feature, which serves as a technical communication feature if any issues were to arise, and also to the poll feature, in which we invite you to answer a few short questions throughout the session. I would now like to hand over to our speaker for this afternoon, Kristen. Hi, Kristen. Thank you for joining us today. Let's start by discussing where exactly are we today with the tech M&A market.
Thank you, Lucy, for that wonderful introduction. Well, it's no secret, tech M&A is booming. Let's first look back at the year 2020. It was a slow start. Much of the world halted to a stop, but the second half showed strong recovery, and this was unquestionably due to tech M&A. Fast forward to a year later, and we are just breaking records all over the place. 936 billion TMT deals were reached just in the first 2 quarters. For comparison, the highest value recorded prior to the pandemic was in the fourth quarter of 2016, when TMT deals reached a record 249 billion. So COVID-19 gave businesses across all industries a glimpse of their virtual futures. And both tech and non-tech companies rushed to buy, invest, and really build their way into the opportunity, mostly by integrating digital tools to meet consumer demands, increase operational efficiency, and generally broaden their customer base. And this activity shows no signs of slowing down. Bain & Company, Morrison & Foerster, Deloitte for the US, they all surveyed deal makers in corporate and PE settings, and all the responses were unanimous. Deal makers are optimistic across the board, anticipating continued increases in both deal size and deal volume. And the key trends driving this growth are still as present today as they were over the preceding year. So it is safe to expect that 2022 will continue along this curve.
That's really good to hear. And what do you think are the key trends that are driving this growth in the TMT landscape?
Well, there are four main trends that I would say driving this growth. So the first and most significant is digital transformation. So initially fueled by the COVID-19 pandemic, we are witnessing new technology and changing technology needs across every industry. The automotive companies, they're acquiring capabilities for autonomous driving and electric vehicles. Industrial companies are buying IoT solutions for Industry 4.0. Financial service companies are buying their way into peer-to-peer payments, e-commerce payments, and blockchain. And as technology needs are changing, more companies are viewing technology capabilities as a strategic differentiator. In fact, in a McKinsey survey, a mere 11% of companies surveyed believe that their current business model is economically viable going forward. So it makes sense that a majority of the M&A deals that we are seeing right now are devoted to helping companies gain new capabilities. In fact, new capability deals have grown sevenfold since 2015. Notably, more companies are focusing on bringing in-house critical technological capabilities, such like we've seen online delivery, telemedicine, teleconferencing, among others. Many deal makers also view tech M&A as essential to transforming their existing offerings and expanding into new markets. For example, Nestle's acquisition of Freshly, a healthy meals delivery company. They acquired them following growing consumer demand for direct delivery.
And within the tech space, what kind of capabilities and companies are these investments targeting? Would it be artificial intelligence or machine learning? Or
well, in fact, more advanced tech, such as AI and robotic process automation and machine learning, they're actually less targeted on the whole. While generally these technologies are seen as attractive and having potential, there is near like universal recognition that these technologies still need more development and testing before they can be widely applied and reliable. More often, businesses and investors are focused on conventional technologies with clear use cases. So for example, cloud technology or CRM, the customer relationship management technologies. These are seen as offering the most opportunities for scale and expansion. They're the hotbeds of investment because they are often the foundation on which companies can build further, more advanced tech solutions.
Thanks, Kristen. So in addition to the driving force of digital innovation, what else is contributing to the resilience of tech M&A?
Well, growth begets growth. The increased activity overall has also increased competition. So this is particularly true in the private equity sphere. Together, acquirers from other industries and private equity now account for nearly 3/4 of deals in the tech sector. We are also seeing both old and new players shake up industries through innovation with the emergence of health tech, fintech, clean tech, ed tech. Take an acronym, put tech behind it. The list goes on. Competition is also being driven by increased regulation, which would seem like a contradiction, right? Because usually more regulation means less deal activity. But investors are looking to beat the clock before new and more restrictive regulations are put in place and deals become harder to close. Add to the competitiveness a superabundance of capital, which is driving high valuations and thus a very favorable deal financing environment. One private equity investor put it this way: every deal is now an auction process. In fact, private equity are sitting on over $500 million in dry powder. And in turn, tech values continue to rise. The NASDAQ index, which is made up primarily of tech stock, and the S&P 500 rose 43 and 41% respectively over the past year. And this is also being encouraged by government infusions. In Germany, for example, the government recently announced that they're going to be infusing 10 billion euros into the local tech ecosystem. So given these favorable conditions, tech M&A looks set to be part of all deal makers' future strategies.
And looking into the future, what do you think are the top challenges that investors and businesses should be on the lookout for in the year ahead?
Well, at the macro level, the tech sector has really seen unfettered growth and innovation for the last few years. But there are big economic and regulatory challenges on the horizon, such as increased regulation, tech protectionism, and more compliance scenarios. And this is to be expected. It is not unusual for the law to take a while to catch up to the actual environment. In terms of regulation, we are seeing increased government scrutiny worldwide on security, data, privacy, platform activity, and so on. There are numerous examples: recent legislation on digital advertising in Australia, China's new data security law, the European Commission's proposed Digital Services and Market Act, which could increase disclosures and tighten competition laws. We are also seeing increased tech protectionism and the tightening of foreign direct investment laws for both national security concerns and just a general rethinking of the commercial implications of localized supply chains. So, for example, in the UK, you have the recent National Security Investment Act that was passed in April of last year. And the EU has also increased government powers to screen M&A deals via the FDI regs. But it's not all bad news. The EU regulators have shown more openness to pan-European deals in general. And lastly, we are seeing more compliance measures spurred on by consumer demand or government treaties. Notably, ESG considerations have taken a place of prominence in M&A deals. This has required the development of new diligence capabilities of ESG criteria. ESG is the requirement to evaluate the environmental, social, and government impacts of a target. And we have seen, especially over the past year, in several cases, it was the make or break issue for M&A deals. And we expect that the initiative will influence many more in the future. So in general, at the macro level, investors and companies need to be alert to the implications of regulatory intervention, political interference, and the added compliance criteria. At a more micro level, many challenges to successful deal making come at the point of deal due diligence, specifically having the capabilities to comprehensively assess open source software and cybersecurity. So the first of these challenges I'm going to discuss is open source software. We're all well aware that software is ubiquitous today. You'd be hard pressed to find a company that does not rely on it in some respect for their operations. But in the field of tech M&A, it is essentially the crown jewels of a company. So over 90% of code in modern software is open source. And this makes sense because of its vast cost savings and efficiency gains attributed to it. So what is open source? In simple terms, it is third-party software covered by an open source license. So open source software, like all software, is governed by copyright. Yes, the same copyright which applies to an author of a book. It's a proprietary right that applies automatically, such that when the author or software editor, they have exclusive rights to it. There are different categories of open source licenses, with some being more restricted than others. Explaining all these differences could take up its own series of webinars. So today we will just talk about the riskiest of them all, the copyleft license, mostly seen in GPL v2. So as background, a copyleft license makes it mandatory to distribute all the source code, which is based on the copyleft or open source work, upon its release to the public. Copyleft ensures that any attempt by an organization to use open source work in a commercial venture isn't viable. It is estimated that some 16 billion lines of code are licensed under GPL v2. So why does identifying it matter? If a company cannot identify all their open source code or dependencies, they are likely unable to ensure that they are in compliance with the licenses, putting them at risk of IP infringement, business disruptions, and reputational consequences. The majority of IP law in the OS realm relates to license compliance. Now, while lawsuits and injunctions are certainly a real risk, they are less frequent. More often, what we see is disruption of business, which can be severe. What does this mean? Well, most of enforcement of OS licenses are carried out by the community or authors of OS. They are the so-called enforcers. And these enforcers often approach the violators in order to obtain compliance. Coming into compliance with an OS license can be an extremely disruptive process. If immediate license compliance is being demanded, a company must take away resources from product development, delaying product release, and instead focus on bringing the company into compliance.
So, Kristen, if we're not really looking at a lawsuit or a court injunction, what would be the risk in simply just ignoring these demands?
Okay, well, a company that has a culture of non-compliance faces two important risks. First, in the competition for talent. Having a good OS reputation should not be underestimated. It's true that today, many young programmers see making contributions to OS as almost a right. Second, a company may be forced to reveal their IP. A well-known example of this risk playing out occurred with BMW. A private citizen happened to notice a GPL license in BMW's program and wrote to the company demanding the release of the source code in accordance with the license. BMW denied this request, so the private citizen published the party's correspondence, and it went viral in the OS community. Eventually, BMW folded and released the source code. So for those that are non-compliant, it is a balancing act. And the question is, what is the lesser risk? Exposing IP secrets or re-engineering the product?
And Kristen, can you tell us what should a complete OSS due diligence scenario look like?
Well, for the risks I just described, it's very important for an investor or corporate player to investigate any potential OS license issues as soon as possible during the due diligence stage, so that any problems may be identified and mitigated. So potential problems that may come up during the due diligence process: the target company lacks an OSS inventory, which may prolong the deal. The company may have an inventory but lack insight into how OSS is being used. This could also mean that they have poor visibility into OS dependencies. The company has insufficient or outdated documentation, non-compliance with the license, or being compliant but not having the latest version. And this raises the question of cybersecurity. Are there vulnerabilities that have been identified in the software? And by not updating them, is the system at risk of a cyber intrusion? So to answer your question, what should a complete OSS due diligence scenario look like? The first would be identify as early as possible and aim to have a complete list of OSS components. Next, assess. This step involves assessing compliance of the OS licenses. It is a situation of trust but verify. Third, use a third-party servicer. So this step builds off the trust but verify approach, but it's also in terms of practicality. One single smart car requires over 150 million lines of code. It is simply impractical to manually review OSS with accuracy without losing time and the competitive edge. It is important to use automated tools for this process, because without which you'll be operating at a disadvantage. Also, the use of a third-party servicer provides benefits to both parties. On the buy side, it's evidence gathered from an objective third-party expert and added assurance that the results are accurate. On the sell side, by using a third-party servicer, the investor or acquirer cannot see the source code. So if the deal doesn't go through, the IP secrets, they're protected.
Thank you, Kristen. What would you say the key concept to walk away with related to OSS due diligence is?
Well, I would say what every investor should take away from this discussion is that it is extremely difficult to operate any company at scale without OSS. So it's there and it needs to be identified early on, given the risks involved. And ultimately, without using the right due diligence tools, the risk is that deals may be slowed down, devalued, or even occasionally unsuccessful. Acquirers do not want to acquire a lawsuit or reputational risk, and insurers' counsels will not want to provide insurance without a clear picture of OSS issues.
Thank you. And other than open source software risks to deal making, what other challenges should we be on the lookout for during the due diligence process?
Well, in addition to OSS, the biggest issue we are faced with today is the pervasive and exponential growth in cybercrime. Every day, at least one of the top stories in any given newspaper anywhere in the world is a story about a major data breach or ransomware attack. And these stories are just the tip of the iceberg, as the majority go unreported or undetected. The global cost of cybercrime and spending on cybersecurity combined is an estimated $1 trillion drag on our economy. The costs go way beyond a ransom payment. There's the opportunity cost for the income loss when a resource cannot be used. There's the reputational consequences from brand damage and loss of trust from a data breach. There's reduced efficiency. They say on average, organizations lost 9 working hours when experiencing downtime. And lastly, the biggie, IP theft. So it comes as no surprise that cyber threats have surpassed overregulation as the top concern for CEOs in the insurance, private equity, banking, and technology sectors. So the importance of running a cyber assessment during due diligence cannot be underestimated. The hotel group, for example, learned this the hard way following a colossal data breach. The data breach was discovered in 2018, traced to a cyber intrusion that occurred years earlier at Starwood, a hotel group that it acquired in 2016. Marriott was subjected to numerous lawsuits and regulatory actions across multiple jurisdictions, costing them hundreds of millions of dollars. And it could have been far worse. Acquiring a company that has vulnerabilities could amount to integrating a Trojan horse. Had proper cyber due diligence been carried out during pre-acquisition, this could have been a different narrative. So while a company may have state-of-the-art cybersecurity, if it acquires a company that has weak security or existing vulnerabilities, it could be liable for any damage from incidents that occurred prior to the merger.
So could you tell us what a comprehensive cyber assessment involves exactly?
So a comprehensive cyber assessment should review both the security in place to protect against cyber attacks and identify any vulnerabilities within the source code. A cybersecurity review would involve assessing the infrastructure, policies, procedures, whether they offer regular training, and so forth. In other words, if instead of a company, we're talking about a house, the questions would go something like, does this house have a security system in place? Is the security system rigged to every window and door? How often is it tested? Do the residents of the home know that they need to verify that a delivery is expected before opening the door to a delivery person? So most companies have generally a good understanding of what it means to protect against cyber attacks, but they know less about identifying vulnerabilities in the source code. So source code security vulnerabilities essentially leaves the window open to a cyber intrusion. The original method for finding security vulnerabilities in source code was to read and understand the source code line by line. But as we discussed earlier with OSS, this traditional method can't really keep up with the fast-paced M&A and funding scenarios we find ourselves in today. No, without the proper tools, we might as well sit out the game. In private equity, for example, companies risk losing up to 20% of their value if they're not seen as cyber secure. When a potential vulnerability could amount to letting in a Trojan horse or integrating a vulnerability that could lead to a data breach, the due diligence process needs to adapt. We are beginning to see this with technology due diligence that integrates automated tools.
And Kristen, given all these challenges that are presented, cybersecurity, OSS, and like you said, a much more competitive environment, how are deal makers adapting to this?
Well, digital tools, they have been making inroads into business processes for years, and corporate and M&A teams and PE teams are no exception. Where the digitalization of M&A process was until very recently just a topic for future discussion, COVID-19 accelerated this by many years. In 2020, I think 70% of Bain and Company respondents cited due diligence as being the most difficult aspect of the COVID crisis. And so it didn't take long for deal makers to turn to technology to conduct proceedings, with nearly all actors increasing their use of virtual due diligence and virtual integration. And this has given rise to a hybrid process. In fact, companies that adapted quickly, developing capabilities in virtual due diligence and virtual integration, made great strides even during the toughest phases of the crisis. And now more than ever, companies are using digital platforms for risk analytics and other differentiated insights to get an edge. Technology due diligence is one of the greatest leaps forward in this respect. Tech due diligence is a process of identifying vulnerabilities associated with the software and its source code by using usually an automated tool that scans the source code in areas such as maintainability, scalability, data security risks, and licensing. Acquiring an awareness of these risks helps investors and buyers mitigate the potential legal, financial, and reputational consequences. So managing M&A and investments today means using digital tools that, coupled with virtual environments, really have the potential to speed up and vastly alter this process. Okay. Yes, I see we are nearing the end of our presentation, and I want to save some time for questions. But first, I would like to explain a bit about the technology due diligence tool we offer here at Vaultinum. So Vaultinum has developed a solution, the Know Your Software, KYS, tech due diligence tool. It provides investors and businesses with critical information on a company's technology and operational environment. It's essentially made up of two parts. So KYS Tech Audit is a software source code scan that analyzes the components of a source code and provides a thorough risk analysis covering IP, security, maintainability, and vulnerability. And it also includes access to KYS online assessment. This is a self-auditing tool that offers cybersecurity, IP, operations, environmental impact assessments, among others. And it is fundamentally company-driven and informed. The final analysis is captured in a comprehensive report. It is independently verified by one of Vaultinum's CTOs. It includes clear findings, expert recommendations, an estimated time of fix, and face-to-face feedback. In simple terms, let me take you back to the metaphor of a house. So like buying a house, you want to know if any work, any renovation needs to be done. And if there is a lot of renovation required, you can adjust the price or choose not to buy. And same if the house is in really good shape and doesn't require a lot of renovation, you can buy it probably at a higher cost. So our tool answers the question of whether the software you're buying or investing in is state of the art. Is the knowledge sharing correct? Can you forecast the tech? Is it secure? Essentially, is what you're buying worth the money you are paying? So KYS Tech Audit is the tool for technology due diligence, delivering information needed to help make informed decisions without losing time or your competitive edge. I know I packed a lot of information into these 30 minutes, so thank you all for being here today and for your time. Now I'll hand it over to you, Lucy, see if we have any questions.
Thank you, Kristen. I see here we have some questions, so I'll start with the first one. It says, is your tech due diligence tool adapted to the sell side of due diligence?
Well, definitely. Thank you for this question. So on the sell side, certainly, you can speed up the deal-making process and actually better position yourself for success by preparing in advance, for example, by completing the online assessment, which will make relevant recommendations for improvement in several areas, including IP, cybersecurity, third-party software. Performing the KYS tech audit also provides a layer of protection. By using a third-party servicer for tech due diligence, you prevent the buyer from actually seeing your source code. So your IP secrets, if a deal doesn't go through, they're protected. It also facilitates insurance process and certification by demonstrating that you have identified, for example, cyber vulnerabilities and you have a plan to mitigate them.
Thanks, Kristen. There's a second question here. It's from Marjorie, and she's asking, how is the source code scanned, and do you come on site to the company to do this?
Well, thank you, Marjorie. Well, actually, it's a very simple process. Our platform, everything is all online. You simply log into Vaultinum, upload your source code, and the scan begins. It's as simple as that.
Perfect. And actually on that same topic, we have a question from Megan saying, if we need to upload the source code onto your platform, how do you guarantee full confidentiality of this source code?
Well, it's an excellent question. Vaultinum, we here have been in the business of protecting IP, which includes source code, since 1976. So essentially 40 some years through our escrow and our deposit platforms, we have been helping software editors and software suppliers secure their BCPs and their copyright in their software. So essentially we are time tested and trusted. Furthermore, we use privately owned servers based in Europe and have ISO 27001 certification.
Perfect. Thank you, Kristen. And we have a question from Mary, which says, thank you for all this information. And on average, how long does it take to do a technology due diligence on average?
Well, this really depends on like sizing and context. Are there multiple products being audited? What is the size of the company, and so forth? But on average, I would say anywhere from 3 weeks to over a month, but it really is a case by case specific.
Okay. Thank you, Kristen. I think that looks like it might be it for the questions section. If there are any further questions that come to your mind, you can feel free to contact us. You see on screen right now, we have Kristen's email and also the email for our sales team. And I'd like to finish off this session today by thanking you all for joining Vaultinum to discuss what this year's key M&A tech trends are going to mean for investors. We really appreciate you signing in and hope that you've learned more about how Vaultinum can assist you in your tech due diligence process. Like I said, feel free to reach out to us via email if you'd like to know more. And please be sure to follow us on LinkedIn to keep up to date with our upcoming webinars. We hope that we'll see you next time.
Thank you, Lucy.
Thanks, everyone.